Let's move on to another problematic area. Is the continent facing another debt crisis? Are we at the doorstep of another debt crisis? What's your view?
So this is the big, big concern. What happened in 2020? Even before that, we know that it had been cheap for many different sovereigns to borrow in international capital markets, and that's completely fine, so long as they are doing everything that is required in the way of reform, keeping confidence up. When you issue a euro bond, ideally you want to be able to refinance that very easily. When it comes to repaying the euro bond, given that you've still got financing needs, are you able to raise enough to repay it, possibly more cheaply, and still borrow anything new that you might need to fund infrastructure? So even prior to the COVID crisis, there had been a concern that growth in the region was slowing, that there had been significant external borrowing, but it wasn't the case in all instances that just because different sovereigns could borrow externally, they could get an inflow of foreign exchange, but they were necessarily seeing the big boost to their own growth potential. In many instances, the commodity price volatility we saw was overriding. So pre-COVID, there's already concern that some countries have debt ratios that are too elevated, and they're starting to spend too much of their budgetary allocations just on servicing that debt. Along comes the COVID crisis, and we see revenue plummet across the board in a way that very few finance ministers would have anticipated. There is a real live crisis, and yes, there is a multilateral response. The IMF comes through with emergency financing for many countries. They, of course, have to be good, not in arrears to the IMF, to be able to borrow even more from the fund. But the problem is that is still lending. That is still a loan that will need to be repaid in 3 years. The G20 proposes a debt service suspension initiative, and that provides very important, what we would call liquidity relief for borrowing countries. If they owe debt to multilateral or official creditors, they can say, maybe, give us a break from having to service this debt up until the end of June 2021. Then there'll be a 1-year grace period, and then we'll resume the servicing of that debt, and we'll have 5 years beyond that over which to repay what we would have had to repay over the time of the DSSI. That is important liquidity relief, but the problem is it does nothing about the debt load of those countries. Now, it's already been recognized. The G20 has already proposed a common framework. The realization that for some countries, they've taken on so much debt that even with this debt service suspension in place, it's not going to change anything. They might as well wake up to the fact that they need to take more significant action to reduce their debt load. And we're starting to see that happening. So Chad, Ethiopia, Zambia, these are countries that have requested common framework treatment of their debt. And the hope is that all creditors, everyone who has lent to these countries, external lending is what we're talking about. It's about the foreign currency borrowing of those countries, that all creditors can sit down together and everyone can come up with a solution that works for all in terms of how to make the debt more sustainable. But for countries that don't go down that route, there is still an issue. And that is many different sub-Saharan African economies were struggling to raise the revenue that they needed to do. If you look at somewhere like Nigeria, its revenue mobilization ratio, the amount of taxes plus the oil related revenue that it collects as a percentage of GDP is in single digits. That's not nearly adequate for the needs of the Nigerian economy. So in many instances, there is this thinking that actually the debt load is too high. And there are different ways that you can work out of that. The most favorable way for all concerned would be if you're still seeing GDP increasing at a very rapid pace, then over time, the debt as a percentage of GDP starts to be less meaningful. But for many African countries, it isn't even that. It's that they collect so little in revenue that what they have to pay in debt service in any one year, when you look at that as a proportion of what revenue they're able to collect, those ratios are very, very high, uncomfortably high. It does have a feedback into what happens with the real economy. So for an investor thinking, should I be investing in this economy? Do they have a relatively low debt to GDP ratio? Does it even matter to me? There's always the risk that something is going to have to change in a big way, that taxes will have to be raised, that spending from government might have to slow very significantly as a way of trying to make this debt more affordable in the future, to bring down debt levels. And that's the overhang. That is the confidence issue that we're going to have to face up to in many different African economies. And it didn't have to be this way.